Hello, good afternoon. Just confirm, can you hear me and can you also see my screen?
Afternoon, say yes, I can see your screen.
Okay. So today we want to continue from where we left in the last session. So remember this subject, like I always say, is about standards. So we have to be going through the standards. So we have done a number of these standards, and still we are on these standards. We are not yet done. So today we want to introduce another standard. In the last session, we were looking at revision. Our last session was more of revision focused. Today we want to proceed with our standards. And the standard that we are dealing with today is a crucial standard again. So remember the approach that I mentioned. We started with the crucial standards first. Of course, the introductory sessions, we started with the lighter standards, IS-16, IS-2, which are basic standards. But ifrs 15, ifrs 16, ifrs 5, even the one that we are going to be doing today are crucial standards. You do need to revisit them, revise them, so that at least you have time to practice them before the exam. That's the main reason why we started with these standards. But believe you me, I think the other standards after this one, they will be a bit light. They will be a bit easier. But for ACCA, we don't get free marks here. Everything you need to make sure you practice enough so that you are well versed with the principles before you get into the exam. So enough with that. So what's the standard for the day? That's ifrs 9. So ifrs 9, what is this about? This is a standard which tells us the investment. How do we record an investment in financial instruments? An investment in financial instruments. So if you are to buy less than 20% shares of another company, if you buy less than 20% shares of another company, you are said to have made an investment in financial instrument. If you buy from 20 to 49%, so from 20% to 49% of another company, that is an investment in an associate. That firm is going to be called your associate. It's an investment in an associate. You buy exactly 50% shares. So exactly 50% shares. That one is a joint arrangement, or can treat that under joint venture account. More than 50%. More than 50%. That's an investment in a subsidiary. So each one of these has a standard. So now we are dealing with a standard which tells us how we account for investment in financial instruments. So we also talk about IS-28, which is investment in associates. We'll also talk about investment in a subsidiary, IAS, IFRS 10. But if it's exactly 50%, you talk about that much in when you're doing SBR. But now it's maybe just need to know that if it's a joint venture, it means we have 50-50. So we will look at the other standards as we proceed. But today, let's deal with IFRS 9, where if we are a company, we have bought less than 20%. Or it can be us selling less than 20%. So it's not only a case of you buying, it can be a case of you selling. So under the key terms that we are going to come across, let's have these key terms. The first key term is a financial asset. So a firm can be said to have a financial asset. We can say this is a financial asset of the firm. What is a financial asset? A financial asset is either cash that you have or a right to receive cash. This is cash or a right to receive cash. Let's think of receivables. Receivables are not cash, but it's a right to receive cash. You can call them and you ask them, how far, when are you paying my balance? Because you have a right to receive cash from them. So a financial asset, it's either cash you have or a right that you have to receive cash. Those are part of financial assets. Then besides the financial assets, we have financial liabilities. So we have financial assets and we have financial liabilities. What is a financial liability? This is now, it's not you receiving, but it's you now paying. So if you buy shares today, you are entitled to receive cash as dividend. But if you are the one that is maybe, if you are to get a loan, you are supposed to be paying. You're not the one receiving, you're the one paying. If you're the one receiving, it's a financial asset. If you're the one that is going to be paying, it's a financial liability. So this one is a contractual obligation. To pay cash or deliver financial asset on terms that are potentially unfavorable to the entity. So it means we are going to pay money, or so if it's a financial liability, we're going to pay cash, or we're going to transfer our assets from the business. We might pay not using cash, but using our assets. We are paying using our assets on terms where we are not the ones that are benefiting, but we are the ones that are losing. So on terms that are potentially unfavorable to the firm. That's a financial liability. Now let's move on. Besides the financial liability, we are also going to talk about an equity instrument. So an equity instrument. An equity instrument. An equity instrument. This is an instrument that gives the holder a right to residue interest. This is an instrument that gives the holder a right to residue interest. In the entity. So a financial asset, let's say we have issued a loan. So let's say we are the ones that have given out a loan. We have loaned money, not the ones receiving the loan. We have loaned money. So what happens if you give someone a loan? They are going to give you money. They are going to be giving you interest, and they will repay you that. So you will be receiving cash. But on the sides of liabilities, if you are the one who has received the loan, if you have received the loan, it means you have to be paying interest. You are going to be paying interest. If you received a loan, you're going to be paying interest. Then an equity instrument now. On the above cases, the person whom we have given a loan does not have any right to the assets of the business. They do not have any residue interest. Meaning, if we pay those we are owing, what remains in the business, it's not theirs. They don't get anything from what remains. But if we issue what we call an equity instrument, this one gives the holder a right to residue income. Let's say, for example, if we get money through shares, if we issue shares, ordinary shares, it means if we are to sell 20% ordinary shares, we want money, we can get it from a loan, that's a financial liability. Or we can issue shares. But if we issue shares, the problem is that will not just give us money, but will also give away part of the business. The person who has the shares is now entitled to what remains after the business has been dissolved. They have a share on the residue income. So their terms, the financial asset, the financial liability, the equity instrument. So let's now move on and break this down further. So let's start with a case where we are dealing with a financial, let's start with a case where we are dealing with a financial liability, or we can start with the financial asset. So in one instrument, it can result in both financial asset and a financial liability. So one instrument can give rise to a financial asset or a financial liability. What do we mean? Let's say there is a loan. If we issue a debenture, So if there is an issue of debentures, let's say of 50,000, the one that is received or the one in possession of the certificates, the one who has given us the money, in their hands, they are saying, I have a financial asset. But to us who have received the payment, to us who have borrowed the money, it's a financial liability. To the borrower, it is a financial asset. To us, the recipient, it is a financial liability. Why? Because the borrower is entitled to be receiving money. They have a right to receive credit. But to us, it's a financial liability. Why is it a liability? We are supposed to pay. So let's have example 1. KD Limited issued 40,000 12% debentures of dollar. So KD Limited issued 40,000 12% debentures of dollar. So in the books of the issuer, to them, it's a financial liability. So to the issuer of the instrument, the one that's receiving the cash. So to KD Limited, this one is a financial liability. So how are we going to account for this in the books of KD Limited? So in the books of KD Limited, we are going to debit cash. So we are going to receive 40,000 in our bank. Then we are going to have a liability. So we're going to have the debentures as a liability. So that liability is a financial liability. So we are going to have our financial liability of 40,000. Then to the receiver of the debenture, recipient, that's a financial asset. So to the recipient, that's a financial asset. So to the recipient, if you are the one that received the debentures, you debit that as a financial asset. Maybe the correct name for the financial asset is an investment. So you record that under investments. So to them, they debit the 40,000 as investment. Then they credit cash because they are the ones that have paid the cash. Then if we issue shares, that one is an equity instrument. If we are to issue shares, it's an equity instrument. Let's have another example. So this one, it was a financial asset and a financial liability. So we looked at a financial asset and a financial liability. But when do we have an equity instrument? Let's have another case. KD Limited issued $40,000 ordinary shares to ABC Limited. These amount to 15% of the total equity. So we have sold 15%. We have sold 15% of our shares. How are we going to account for this? So in our books, we have issued an equity instrument. In our books, this is an equity instrument. So in the books of the issuer, this is an equity instrument. In the books of KD Limited, the issuer, this is an equity instrument. How do you account for this? These are journal entries that you already know. I'm sure you know how to record a liability, how to record, but these bases, we will need them later on. That's why I have to repeat them. But maybe I've just added the terms. Like here, I've just added financial liability. But you know, if we issue a debenture, the money is going to come with debit cash. We credit the financial, we credit debentures, which is a financial liability. Then, if we issue shares, we are going to debit the cash, confirming that we received the cash or bank. Then what are we going to credit? We are going to credit the equity instrument. Yeah, the ordinary shares. Credit our equity instrument, which are the ordinary shares. But what about to the one that has bought these shares? To the one that has bought these shares, to them, they've bought less than 20%. It's a trade investment. To ABC Limited, who has bought the shares? It is a trade investment. And regarded under or recorded under financial assets. Recorded as a financial asset. To them, they are receiving money in the form of dividends. They're entitled to dividends. So in this case, to ABC Limited, again, in terms of the amounts there is not changing anything. So to ABC Limited, They bought the shares. To them, it's not a liability. So to them, it's a financial asset, which is investment. However, they are going to lose cash. So we can get a financial asset either through issuing loans. We can get a financial asset through buying shares. So a financial asset arises if you are entitled to receive it. A financial liability if you are going to be paid. An equity instrument, we don't pay interest, but the holder is entitled to residual income and they may be entitled to a dividend. So let's have classification of financial instruments. The financial instruments are put into different categories or classes. So a question can say this is the financial asset through profit and loss. Financial asset through, they can say financial asset at fair value through profit and loss. We can also be given financial asset at amortized cost, financial asset through the OCI. So when do you say this is a financial asset through OCI and what is the effect? I'll show you just now. So the first type of a financial instrument we are going to talk about is, the first one is the financial asset through profit and loss. The financial asset through profit and loss. Let's move on. So financial asset through profit and loss. If an instrument has been classified as a financial asset through profit and loss, when you are recording this instrument, you initially recognize it at its cost. Let me have that down. So if an instrument is classified as a financial asset, profit and loss, then the following must be taken into account. So remember, we have a case where we're saying, for example, we issue a loan. So if we are, we are the ones that are to, let's say we are the ones that are giving the company money and they've given us the debenture certificates. To us, that is an asset. So let's think as a company, we are the ones that received the certificates and we gave people loans. So to us, it's a financial asset. But that financial asset can be classified as financial asset through profit and loss. I'll talk about on what grounds do we use to say this one should be a financial asset through profit and loss or not? But if an instrument has been said to be a financial asset through profit and loss, number one, it is initially recorded at its cost. So an instrument, this instrument is this instrument is a financial asset through profit and loss. In your business, you initially record it at cost. And let me add to this. The cost excludes transaction costs. The costs exclude transaction costs. I'll give you an example. The transaction costs are then expensed. The transaction costs are then expensed. Let me just say one more point before I forget. The gain or loss in fair value of the financial so the gain or loss in fair value of the financial assets are taken to profit and loss. Okay, let's have a real question to maybe shed more light. The question can have this statement. We can be told that the company bought $80,000 ordinary shares. Yes, 80,000 ordinary shares of ABC Limited. These amount to 10% of the shares in ABC Limited. So these amount to 10% of the shares in ABC Limited. Then in addition to that, they can say, in order to facilitate the acquisition of these shares, the firm incurred brokerage fees of 2.5. Brokerage fees of 2.5. At the end of the year, the fair value of the fair value of the investment. So at the end of the year, the fair value of the investment, we can say, so you're saying the company bought these shares at 80,000. So at the end of the year, we can say the fair value of these shares had gained. I think I was also supposed to add here that the company bought 8,000 ordinary shares of ABC Limited at, you can say at at $25 each. The shares were bought at $25 each. At the end of the year, the fair value of the shares was 115,000. So then the question is, how much is to be shown as investments in the financial statements and how much is to be expensed? So show the effect in the income statement. So in our income statement, the first thing, maybe let's also add that the investment was to be held at fair value through profit and loss. So this will give us a guide that we are dealing with an investment which is said to be held at fair value through profit and loss. So if the investment is held at fair value through profit and loss, if the investment is done at fair value through profit and loss, if the investment is done at fair value through profit and loss, we said that the instrument is classified as financial asset. So we said it is initially recorded at cost. So initial measurement. We are going to record investment. On the day of buying these shares, because it's us that bought the shares, we are going to debit our investment in financial asset of that's 80,000 times $25. It's not us issuing shares, it's us buying shares. So we are going to have an investment of 100,000. Then what are we told next? We are told that there were brokerage fees. But if it is this method, transaction costs are not included as part of the cost of the investment. When you're calculating the investment, you don't include the transaction costs. So in your non-current assets, you initially recognize investments of 100,000. Then at the end of the period, you are going to recognize the fair value. So this is on the date of initial measurement, you've recognized 100,000. But we are told at the end of the year, the investment is now 115,000. So at the end of the year, the investment is now 115,000. So there's been a gain in the investment. So there's been a gain in the investment of 15,000. So this is where I was saying, if there is a gain in investment, in fair value, gain in fair value, the gain or loss in fair value is taken to profit and loss. So this gain in fair value, the gain of 15,000 in fair value is taken to profit and loss as an income. If it was a loss, we would take it as an expense. Okay, then how much are we going to enter in the income statement? So in the statement of financial position, initially our investment was 100,000. Then it gained by 15. So the fair value is 115, but the gain, we take it to the income statement. Then in the expenses of the company, this is where you put the brokerage. So the transaction costs are expensed. So we put brokerage fees. So we might hire a broker to help in the buying of this share. So the brokerage fees was, I think, 2.5. Then income, because there was a gain, that income, you're going to add it to the income section. So this is how we're going to account for this. So I said initially we recorded costs, that's 100,000. Then excludes transaction costs. Transaction costs are expensed. Then the transaction cost, we have mentioned that. The gain or loss, if it's a financial asset through profit and loss, is taken to profit and loss. Okay, let's move on so that you note the difference. What's the deal with the other issues? So the second one is, we can say we are classifying the investment as a financial asset. Through OCR. So we can have the financial asset through OCR. Can have financial asset through OCR. So the financial asset, it can be through profit and loss, or it can be through OCR. Let's move on. If we say this is a financial asset through OCR, what are the rules? So for a financial asset through OCR, number one, under this model, the transaction costs are capitalized. So the transaction costs, the initial transaction costs, they are capitalized. So it means if you're initially recording your investment, you would say the 100,000 plus the 2.5. So in your investments, you would record investments of 125,000. You'd record investments of 125,000. Then under this model, the fair value gains, are not taken to profit and loss, but they are taken to other comprehensive income. So the fair value gains are taken to other comprehensive income, which is the OCI. So if their fair value gains, that gain, like the 15,000 we calculated earlier, that gain is taken to other comprehensive income. Just a moment. Okay, let's proceed. So I was saying the gains are taken to other comprehensive income. Not maybe the fair value gains yet, the gains or losses. So the gains or losses, these are recognized fair value gains or losses are taken to other comprehensive income. So instead of taking them to profit and loss, you then take them to OCI. So in this case, let's look for the gain or loss. So we would say initially the investment is 125 because the transaction costs are capitalized. I think I made a mistake there. Is it supposed to be 125? No, it was 2.5, not 25,000. Let's adjust there. So we are going to recognize an investment of that. Then the fair value at the end of the period. The fair value is now risen to 115. So the fair value gain, we are not comparing with the 100,000, but is with the initial 102 we recorded. So the gain of 120 of 12.5, the gain of 12.5 is taken to other comprehensive income. The gain is taken to other comprehensive income. Okay. Let's move to the next model. So that's the difference. If being treated as fair value through OCR, how we treat the transaction costs differ, and that will affect our fair value. That will also affect the expenses because the transaction costs are capitalized, not expensed. Then we also have what we call a financial asset at amortized cost. So we have a financial asset, or we can say asset, or yeah, let's start with the financial asset at amortized cost. Financial asset at amortized cost. So if a certain instrument has been classified as a financial asset at amortized cost. So for a financial asset at amortized cost, number one, again, under this model, the initial transaction costs are capitalized. The initial transaction costs are capitalized. Then a financial asset that is held at amortized cost, it does not suffer fair value changes. So we can say there are no fair value changes. There are no fair value changes under this model. And they are, okay, let's put that one separate. They are contractual cash flows received. So if it's a financial asset at amortized cost, we use it if the financial instrument that we have does not either gain or lose value. Let's think of a loan. A loan is not going to increase or reduce value. It remains the same amount, and the interest is a fixed rate. The shares can gain or lose value based on how we are performing. But if it's a loan, the same amount of loan that we have borrowed, it will remain the same. It doesn't gain or lose. Of course, it can lose as a result of inflation, but I mean the amount that you're supposed to pay. If you borrow 50,000, you still pay 50,000. So in that case, the value of the loan will still be 50,000, the first value. So if the instrument is not changing value and they are contractual cash flows. What do you mean by contractual cash flows? They're saying the money that the other party is receiving, we have clearly stated it down. It's not going to be changing. Interest, it's clearly stated how much interest you're going to be paid. So I can say this is common in debentures. So this is where we normally receive contractual cash flows. In the income statement, we record finance income, we record finance income. So we don't have fair value gain or loss because this model does not recognize that the instrument gains or loses value. So if I give you a loan of 50,000 To me, it's an asset because you're going to be giving me back the money. But the money you're going to be giving back is fixed installments. So what can show that these are contractual cash flows? Normally, they are of fixed amounts. So if we are going to be receiving contractual cash flows, which are normally fixed amounts, then the model to use is the financial asset at amortized cost. It's us receiving the cash, but we are going to be receiving the cash in fixed installments. Then the last one is classification of a financial liability at amortized cost. This is just the opposite of financial asset. So the financial liability at amortized cost. The initial transaction costs, this time they are not added. The initial transaction cost is removed from the cost of the instrument. So if it's a financial liability at amortized cost, the initial measurement, we deduct the transaction cost. So if we are to receive a loan, received, because this time is a liability, received a loan and paid we received a loan and paid the bank. Okay, let's say we received a loan of 20,000. And paid the bank $2,000 to process the loan. So if it's a financial liability, initially, when you are recording it, we are saying, you got a loan of 20,000, but you had to pay 2,000 to get it. So in other words, what you received is not 20, but you received 20,000 minus 2,000. So if it's a financial liability where we receive fixed payments. So for a financial liability, we are saying 20,000 is what we receive, but 2,000 we paid it back as charges. So the amount you initially record is 80,000. So if it's a financial liability, you less transaction costs. Why is it for the other ones we were adding? For the other ones, if you check, these were assets. The first one, it was a financial asset through profit and loss. The other one, it was a financial asset through OCI, financial asset at amortized. So for financial liabilities, financial liability at amortized cost, you less transaction costs. Then let's move on. When recording the liability, we make use of the amortization table. If you still remember the amortization table, I think we did look at it under leasing. We use the amortization table. Then let's move on. What else may we need to add? In the income statement, we record finance. In the income statement, we record the finance costs. We have no fair value gain again, so we record the finance costs. When calculating the finance cost, we use the effective rate of interest. So in calculating the finance cost, we use the effective rate of interest or effective interest rate. So I have given you an example for the first one and the second one. So for amortized cost, don't worry, I'll give you a full example. For how do we account for this? If it is a financial asset at amortized cost or a financial liability at amortized. But before we get there, let's look at the criteria, the guiding criteria. To decide which model to use. So before you can say this one, let's say the question is silent. If the question is mentioned that the financial assets are held at fair value through OCI, then that's your advantage. If the question is silent, how do you deal with it? So the question is just told you we bought these assets, but we have not been told whether they are being classified as through OCI or they're being classified through profit and loss. So what is the guiding criteria? What can we use to then decide? So in order to determine the model to use, when you're determining the model to use, there are two tests that you can make use of. In determining which model to use, we can use the contractual cash flow test and the business model test. So we have the contractual cash flow test and what we call the business model test. So we have the contractual cash flow test and the business model test. These tests can help us in classifying whether the instrument is to be classified as A, B, C, or D, even if the question is not stated. So let's start with the first one, the business model test. The business model test. If using this model, the reason behind entering into a certain, the reason behind entering into a certain transaction determines its classification. So in this case, we are saying the reason behind buying the instrument determines whether should we classify it under, normally the business model, it works for A and B. So if we bought the asset with the intention of keeping it for a long time, remember investment is an asset. So if you make an investment and you are planning that this investment, you bought these shares and you are planning that you are going to have these shares for a long time, then your intention is to keep the shares. But on the other hand, we also have some that can buy the shares with the intention of reselling them. So we can say if the instrument has been acquired with the aim to keep the instrument for a long period of time. If we have bought the shares and our intention is to keep them for a long period of time, then we record it as a financial instrument through OCI. So if the investment or the instrument, we want to keep the instrument for a long period of time, then it must be recorded as a financial instrument through OCI. So if you buy shares to keep them for a long time, even if the question is not specifying which model, as long as that they mention the company intends to hold these shares. So if you are intending to keep them for a long time, you record that as an investment, as a financial asset through OCI. We have bought the instrument to keep it. But in some cases, we can buy an instrument simply so that we take advantage of the gain in the value. So you can remember, like shares can fluctuate in value. With those that are in the business of shares, they can buy the shares when the prices are low and sell them when the prices are high. So if we buy shares with the intention of reselling them, we buy the instrument with the intention of not keeping it for a long time, we are said to be keeping it for short-term benefits. Then the instrument should be held at fair value through profit and loss. If the instrument is to be kept for a short period of time, if the instrument is to be kept for a short, not or can say for short-term gains. For short-term gains, or even short period of time, we recognize the instrument. We recognize the instrument as an investment. Or we can say we recognize the instrument at fair value through profit and loss. So under this, we are saying the reason behind, the intention is very important. If the intention is to keep the instrument for a long time, then it's the financial instrument through OCI. But if the aim is to keep the instrument for a short term, then it's fair value through profit and loss. I've shown you how you account for the fair value through profit and loss and fair value through other comprehensive income. But classifying the instrument as fair value through profit and loss increases your profit if there is a gain, and it means more taxes. So the entity, if they want to delay the payment of tax, they can elect, even if they are keeping the instrument for short-term gains, they can elect to recognize the gains or losses through OCI, not to, so we can say, even if the instrument is kept for short-term gains, the entity can elect to transfer the gains to OCI. This is upon election. You can elect to put any gains that are going to arise. They are not going to be charged in my profit. Can they be charged to other comprehensive income? So the other comprehensive income is not part of the tax amount. Then we move on to the contractual cash flow test. So the business model test is mainly of help in determining, should we say this is this one going to be recorded as a financial instrument through profit and loss or through OCI? Then the other model is the one that tells us when do we classify a transaction under amortized cost, like financial asset or financial liability at amortized cost. So the other one is called the contractual cash flow test. The contractual cash flow test. The contractual cash flow test. If the entity is receiving or paying periodic interest, receiving or paying periodic interest, and then the principal amount being repaid at a later date. The principal amount being repaid at a later date. Upon maturity. Then the investment should be recorded as a financial instrument at amortized cost. So we can enter into an agreement like in a loan agreement. Loan agreement, you'll be receiving interest. These are the contractual cash flows. You'll be receiving interest that we agreed. And at the end of the period, you're supposed to repay the principal amount. So if it is the contractual cash flow test, we check that. In this agreement, are we receiving fixed amounts as agreed, or are we paying fixed amounts? So receiving or paying fixed amount, it can give rise to it being a financial asset at amortized cost or a financial liability at amortized cost. So remember that if it's either a financial asset at amortized cost or financial liability at amortized cost, they don't have revaluation gain, but they have a loan amortization, they have an amortization table. NB both the financial instrument at financial instruments at amortized cost. Make use of the amortization table. They make use of the amortization table. Let's have an example. So let me try to think of the best example here. You can say KD Limited KD Limited issued 100,000, 8% loan stock. Issued 100,000, 8% loan stock. The issue costs amounted to the issue costs amounted to 4,500. The issue cost amounted to 4,500. We can then also be told that the effective interest rate the effective interest rate the effective interest rate was 5%. Then the loan is repaid to be repaid in 5 years. The loan is to be repaid in 5 years. So it means in this case, going to the test, this one, we are going to be paying contractual cash flows. What do I mean? This is a loan. A loan does not say if it's a 100,000 loan, we are going to pay 100,000. But on top of that, we pay interest. So there is the interest on the loan, which is 8%. Assuming it's of dollar. So the interest is 8,000. The interest is 8,000. Then, how much did we receive? So if you are determining the interest is based on the coupon rate. The coupon rate, that's the amount of the loan, the 100,000. Then the amount we are going to receive here, we are going to receive 100,000, but we are going to pay transaction costs of 4.5. In our loan amortization table, we are going to start with 9.5, 95,500. What am I talking about? So if you have recognized that, okay, this one, we are going to be receiving interest, we are going to be paying interest. And at the end of the 5 years, we'll repay the initial amount. It means that you are going to have your amortization table. Here, you have your opening balance. We use that one where we were dealing with arrears, where we start with the finance cost. We have the balance. Amount paid. Then the balance. In most cases, interest is paid in arrears. So if it's interest, we will pay the interest after the year, not at the start. So in year one, the opening balance is the amount we received. The finance cost is based on the interest rate. The effective interest rate is 5%. So you take the amount received times the 5%. Then you add that. Then you less the amount paid, 8,000. So the amount paid, it does not change. So the 8,000 remains the same. Then the closing balance here becomes the next opening balance. Then the finance cost is 5%. This balance does not change, you drag it. Let's just do up to that. So when you're now accounting for this, remember in the first year, the finance cost is what you take to the profit and loss. Let's go and check, did we mention that in our notes? So if we go to this one, I had not given you an example for the financial, this one is a financial liability. So I said initial treatment, you remove the transaction costs. So like in this case, we have removed from the amount we received, we removed 4.5. That's how we got the opening balance. Then after that, when calculating, the finance cost is the effective interest rate. In the income statement, we record the finance cost. So in the income statement, the amount we are going to record for this interest, for this loan, it's not the 8,000, but it is the 4,775. So it is not the 8,000, I repeat. The interest is the finance cost. So in the income statement, under your expenses, regarding this loan, we don't record the amount, the interest rate, but we are recording the finance cost. We are recording the finance cost. Then in the balance sheet, the statement of financial position, you split the loan into its current and non-current. So the current liability and the non-current. So the current, let's start with the non-current. The non-current is the balance for the next year. The current is the difference. This year and next year balance. So I think I need to leave you digesting this. We'll finish it. We'll finish the standard in the next coming week. So I want you to go through this. I understand it's a lot of information we have discussed today. So we're going to finish it up next week. So I would want you to, first of all, on your own, now go to your notes, read the textbook. We're not yet done, but now you have an idea. Now we've been talking about it, so now you're not blank, you have an idea. So you can go and read that standard. We'll finish it up in the next coming week. Then I'm sure from the list, let's go back to our list that we had and just check on our progress. Please, if you missed anything, remember all these sessions were recorded somewhere. Either they were recorded as an audio or you can access the video. So those that have been marked in yellow, we've done them. Okay, I think the pace is okay because after this one, we look at consolidation. Then the rest of the standards, some of them we can even cover 2 in a session because they won't be having much. So after this one, another main area is ifrs 10 consolidation. So for today, thank you so much for your time. For today, let's end here.